Hi, everybody. We are live. I'm Debbie Schwartz, founder of Road to College, and I'm with Melissa Bassett, who is the head of in-school lending at SoFi. Hi, Melissa. Thanks
Hi,
for
Debbie.
coming tonight.
Thanks for having me again.
So I'm going to give everybody the chance to kind of you probably just got notified, and maybe you can just say a comment, say hi, tell us where you're from, tell us how many kids you have, what year your child is in school, because, what we're going to talk about tonight, and I put this out in the group and I put this out in my email, I hope that, this applies to a wide range of people. It obviously, we're going to talk about student loans. It definitely applies to anybody who needs to take out a loan. So that kind of first-time parent, and if you have a student in college. But I really encourage parents of younger students, if you were in high school, to also listen, because I think it's great that you start to understand the process ahead of time, because you might hear things tonight that might make you change what you're doing now, or maybe you want to improve your financial situation, to improve your credit. So anyhow, I hope that there's a good range of people on tonight. So please say hi. I always like to make sure that you can hear us, because I do see that Anne is saying hi from New York. So she's got a college sophomore and a high school senior. So you are our perfect target audience, Anne. Thanks for showing up. Okay, great. So, and while people are saying hello, Melissa, I'd love for you to kind of give us a little background on yourself, and SoFi, because I think people may know the name, but may not know it for student lending. So that would be helpful to kind of educate people.
Happy to. So as you said, my name is Melissa Bassett, and I head up the in-school lending group here at SoFi. And what SoFi is a digital financial services company. So we're based out of San Francisco, though we have locations in about 10 different offices across the country, in Florida, Texas, New York, Pennsylvania, Utah, and of course, California. And we started out in 2011 as a student loan refinancer. So we refinanced student loans, and really that was our only product that we brought to the market. But we became very well known for refinancing at the time, combining both federal and private student loans into one loan, and helping our members, who are our customers, lower their interest rates and lower their payments. And really from there, our business model was born. We bring digital financial services and products to everyone, throughout the country. We started out, as I mentioned, kind of in that millennial alleyway, with people refinancing their loans. But today we offer money accounts, which is an online bank account. We offer investing tools, private student loans, which we're talking about today, personal loans, mortgages, and
just a whole host.
It's a lot of stuff. Yeah. So we're really a broad and now global international financial services company, but 100% digital.
And is this the first or the second year in actually student loans that they call it origination, if you're getting the loan for the first time?
This is our second year as a lender in student lending. And Debbie and I, for the group, were just talking about how there's been a lot of turnover this year in student lending. We've had some lenders like Wells Fargo and SunTrust Bank both exit the student loan industry. Not for any reason, strictly, nothing dramatic, strictly business change or business model change. And so it's a great opportunity for people like SoFi to jump in there and fill that need. We're here to stay. As long as students need loans, we're here to help you, and hope to continue to do so for many years into the future.
Well, so this is the second time I'm doing a Facebook Live with Melissa. We did one a few weeks ago, which was part of like a 3-day series of helping educate people on student loans. So tonight, we thought we would just kind of do a quick summary of kind of the high points that people need to know about student loans, because I have a feeling that most people who are on tonight are probably further along the research process of having to get student loans. But we thought we would do a little bit of summary of important things. And then we have a host of really good questions that people sent in, and that Melissa has been hearing on the phones that probably apply to what a lot of people are dealing with. So we thought we would go through that. And then kind of mixed in is Melissa has a ton of experience working in student loans at several different companies. And so and we were talking earlier today, I just think it would be great for you guys to kind of hear her industry insights about kind of how different sites work, kind of on a summary level of how lenders kind of look at different pieces of information. Because again, going to the families who maybe have some time, who can kind of change their financial situation, hearing this information is really valuable now, so that you're in a better situation when you actually need to apply for loans. So that's our agenda for tonight. Okay, so let's get started. And maybe Melissa, you can just kind of give some summary information for people who may not know things like the federal student loans and the limits that students, kind of hit up against each year, and then, what happens after you hit those limits.
For sure. And a lot of the terms get jargony. So Debbie, make sure you check me if I use like an industry term, but I'm sure everyone so far that has a student going to college next year, and in the comments, we'd love to hear from you based on your plans for next year. Like, are your students, going to school from home? Are they going online? Are they going to campus? And any concerns you have, financing in those environments, we can help you with too. But by now, I'm sure everyone's completed the FAFSA form. And one thing I want to say about the FAFSA form is there's a lot of, if you go to a cocktail party and someone brings up the FAFSA form, you're going to get 10 different answers. So there's no trickery around it. Everyone absolutely should complete it. It's not going to be, given over to the admissions department to, have collections come and ask you to donate money. It really is a very simple form. I did mine this year on my phone on the app. The federal government has turned the FAFSA form into an app, super easy to use. But get that done. And for families that are now considering student loans, whether it be one for your child or for the parent, it's not too late. So get that FAFSA form done. And after that's completed, you probably have already received your award letter. And in the award letter, families will see that the school will actually award federal programs like the Stafford program. There's two types of Stafford loans, or direct Stafford loan and direct unsubsidized Stafford loan. And what that means is the federal government will pay the interest while the student is in school. The unsubsidized is the government will not pay the interest while the student is in school. Now, the student can defer it. And what does that mean? So if they have to pay the interest, they do not have to make payments on either loan while the student is in school. And that can be deferred for all 4 years or 2 years if you're going to graduate school. So it's a great feature. As you alluded to, Debbie, there are loan limits. They're quite low. So as a freshman, you can borrow about $5,500. It goes up to $6,500 in your sophomore year, $7,500 in your junior and senior year. And as we know, tuitions are significantly higher than that. But we definitely recommend that should be the first stop, is the federal loans for the students. After that, there are a couple of different options to consider. One is private student loans, which we're going to talk about tonight, but also the Federal Plus loan. So the Federal Plus loan, which is the acronym stands for Parent Loan for Undergraduate Students, is available to the parent. The student is not on the loan. You can borrow up to the cost of attendance, less any other financial aid that the student receives. So for example, if the cost of tuition all in for you is $60,000, after taking the Stafford loan, maybe you've gotten a merit award or you have some savings and there's a gap that you need to meet. Let's call it $25,000. You as the parent can borrow that through the federal government. Now, a couple of things. The interest rate this year is 5.3%. There is about a 4.3% origination fee that comes out of that. So that's something to think about when you're borrowing. Say you're borrowing $10,000. What's going to be dispersed to the school is $10,000 minus the fee, if that makes sense. So that $430 is going to be deducted from the loan proceeds. So you need to borrow a little bit more than you actually need to cover that fee, since it is deducted. So that is an option. There are very generous in-school deferments with that, so the parent does not have to make a payment while the student is in school, but the payment truly is in your name as the parent, and you are responsible for paying that back. Now, often we're asked questions like, can I transfer this to my student when they graduate? Keep in mind, it's in your name as the parent, and the loan will stay with you.
Right. I was going to say, and people sometimes don't realize, this year, the interest rate is 5.3% on the Parent Plus loan, the origination fee, as Melissa said, it's, we're rounding up, it's about 4.3%.
Yep.
That origination fee happens every year you need to take out the loan. So I try and emphasize to people, honestly, factor that number in. So you're really not looking at 4.3%. I'm sorry, you're really not looking at 5.3% at the interest rate. It's actually kind of closer to 6.3%.
That's right. With the APR, or annual percentage rate.
And if you're trying to compare apples to apples, that's the number you should really use.
Yep. And I know I saw a quick question there. There is no age limit on the parent loan. Anyone can, as the parent, you can borrow that. There is very light underwriting done, so you won't have to produce any income documentation. You do have to have no charge-offs, no bankruptcies, no severe delinquencies on your credit bureau. But you wouldn't go through a traditional underwriting process like you might for a mortgage or a car loan where you have to show your income. However, should you go through that in the private market, there is a very good chance that you could get a rate less than what the federal government is offering.
So I just want to, before we kind of get too far along, there's a question here by Emily, which is kind of long, so I won't show it. But basically, she's asking about like the timing of loans. If you have some savings, but you probably don't have savings to cover all 4 years, how do you figure out what years to take the loans in? And there's not going to be a set answer for that because we don't know all the details. But maybe you could talk, Melissa, about the fact that once you finish a year, you can't go back and take the loans that you didn't take the year before. And these are kind of like, I don't know, I don't want to say special, but these are years where these interest rates are extraordinarily low. And so it might be to the advantage to take some of these interest rates out. You have to kind of look at your 4-year plan.
You do. And I think that's great advice. When you're looking at financing education, it is such an anxious, anxiety invoking thing. It's kind of like doing your taxes. You're a bag of nerves until you hit that button and it's done and it's gone and you can kind of celebrate it. It's the same with paying for tuition. And what I suggest to everybody is to sit down with, good old paper and pen and write out the 4-year plan. What does it look like? What is your cost after loans, the Stafford loan or the award that you got from the school? What are you looking for at paying in that gap, and carry that across 4 years? So to your point about having some cash on hand, and this is what I did. I have one son that graduated this year, and I have one that's a sophomore in college. And what I did is I took the savings that I had and divided it over the 4 years. So it's not going to cover all of the expenses, but it is going to cover a portion. That's just kind of what I chose to do. But I would not take all of your cash, again, recommendation, and throw it onto the freshman year. Just take it and kind of treat it as a 4-year plan. But the federal loans, Debbie, to your point, is really something that we encourage every student. I know, mom and dad, you're probably thinking that you don't want your student to be burdened with it, but you saving for retirement, you don't have less time to do that than they do to pay off their student loans. It's a good rule of thumb for them to take that even if it's only $5,500, by all means, do it for the freshmen.
So, and Sue is asking about the Stafford and Plus loans. Can you pick the term, or is that 10 years set?
It is 10 years set. There are repayment plans for those people that, for example, may be going into public service once they graduate, or special circumstances, but the standard repayment is 10 years.
Anne has a question, which I think is actually one of the questions on our list, but I'll generalize it. And people have asked this, like, what if I apply for the Parent Plus loan at the same time I'm applying for private loans, because I'm not sure, how they're going to come out.
Yeah.
If I get a better loan someplace else, whether it's private or in Anne's case, it's a state loan, can I back out of the Parent Plus loan?
You can. So, and I know there's some great state programs out there that have very low rates. And what I would recommend, Anne, is to compare the features of the program against the parent loan. So make sure that you can defer payments if that's what your need is, or you can make interest payments if that's what you want to do. Check out the repayment terms. Is there, I know this is kind of morbid, but it's important, is there a death provision on it? Many private lenders today will forgive the loan if the student should anything should happen to the student while they're in school. So there's some protections and some features that are just as important as the rate. Check those out. If you still want to go ahead with the loan, because there's definitely some great low rates out there, all you need to do is call the financial aid office or email them and just say, I'm going to go with another option. Please cancel the Parent Plus loan, and they will do it on their end.
Okay, great. So we kind of, quickly went through Stafford loans, Parent Plus loan. So kind of why would a family consider a private loan versus a parent loan, the Parent Plus loan?
So it really is a matter of kind of preference and who the family wants to be the main repayer of the loan. So as we talked about at the beginning, on the parent, it's right in the name, Parent Plus loan, you, mom and dad, are in charge of repaying that back. In the private loan market, most families choose to have the student be the primary borrower and the parent will co-sign it. Now, the loan is generally underwritten, so the underwriting or the credit evaluation is done on the parent cosigner, which is kind of a nice feature. There's not a lot of programs out there, whether it be a car loan or a credit card, anything that's credit-based, where we kind of take the student into consideration, but their parent really is the one that we underwrite to, so it gets the great rate. And so that's one important difference. With the student, you want the student to have the loan in their name, private would be for you. Another reason would be the interest rates that we discussed. You could probably get a lower, if you have, decent FICO and income, you could get a lower interest rate. And many lenders have different, I shouldn't say many lenders, there's not a lot of us left, but the major lenders have options. So for example, you say you wanted to borrow and my dog just came in. So say you wanted to borrow a student loan, but you knew that you would pay it off within a short period of time. Say 5 years. Private lenders will give you a very low interest rate for paying that loan off within the 5 years. Conversely, someone asked about the 10-year repayment term. Say you want to, you're going to need 15 years to pay back the loan. Private lenders will offer you that. So I find that there's a lot more optionality in the loan kind of construct in the private market, where you can pick your repayment term, you can pick your repayment type, whether that be you want to only make interest payments, or like at SoFi we offer, you can make interest payments, you can make a $25 payment, you can make a full payment, full principal and interest, or you can defer the entire thing until the student's out of school. So flexibility, I think, options, and in some cases, some really low fixed and variable rates this time of year in the economy is some of the benefits.
So I'm wondering if you could kind of share a little bit, and whatever detail you can go into is fine, or whatever you can't, but kind of what are the pieces of information that lenders do look at to kind of figure out what are they evaluating when they ask people information? Is one thing a little bit more important than another? And this is to both help the people who might be a year or so away from having to get a loan, so that they might improve some of their, financial stats, and also maybe help understand the people who are applying now, why they might get a certain interest rate versus not getting, the lowest rate that they see advertised.
Yeah, and Debbie, that's a really great idea to pre-plan. For those of you that your kids are not on their way to college yet, maybe you have a couple of years, you can certainly, work to repair your credit if you think that your FICO may not be strong enough. But what most lenders will look at is a combination of things. One is FICO score. Now, FICO is not the only determinant. So if you have, for example, a FICO score that you don't think is, as high as you would like it, that can be offset by your income. So say you have a steady income, you have kind of an average FICO score, it is likely that you would get approved. The things that would exclude people, so the things, when would you get denied? Charge-offs, a lot of debt. So do you have a lot of revolving debt and debt to income? What is your debt to income? Not necessarily.
And just define revolving debt for the people who may not know that term.
Do you have a lot of credit cards? Do you have a lot of credit cards? Because we assume most people have either a housing payment, rent payment, car payment, but are there a ton? Do you have a lot of? Are you overextended? And one of the things that is somewhat new to underwriting is really looking at how much free cash flow do you have at the end of a month. So for example, you might have, say someone has an income, and I've seen this, in our own underwriting, say you have an income of 50,000 a year, FICO score, say, of 800, and you think, oh, I'm never going to get a loan, even though I have great credit, but you have no debt. Well, you have enough, you have a nice cash flow, or money at the end of the month to make that payment, and you would be a great candidate. So I don't want people to think that they need to have, high incomes, pristine credit. Like it's really kind of managing your debts against your expenses and being able to fit that payment into your monthly budget.
And do you find so it's funny, it's interesting. I actually got an email from somebody today that kind of had that very situation where she said, I have she had over 800, FICO score, but she said some of the lenders said her income is too low. And I don't know the specific income number, but is it worth actually calling and talking to the lenders to kind of see what this, your particular situation is, what is causing,
It is. It is, and a lot of us have very specialized contact centers that can talk to you about what is needed. And in the digital age, if you have the patience, I know a lot of us are short on that, but if you have the patience, websites are great information. I know that both at SoFi and at our competitors have eligibility. What are the eligibility requirements? What do I need to bring to apply? What are you looking for? So there's a lot of information out there to look at, to see if you would qualify, but by all means call. And if you'd rather chat, a lot of lenders offer chat, where you could ask some questions and talk to the lender.
I wanted to bring that up is people shouldn't think that whatever the response back is, it's that is the final answer. I'd like to encourage people in all parts of this process, whether it's talking to a college, talking to financial aid offices, call and see if you can actually get on the phone with somebody to get a better understanding of what's going on.
Absolutely. And I know that there's a lot of credit unions that are in the student loan program, and they all kind of roll up, I would say, to a main group that helps them facilitate the program, not every credit union is a lender in and of themselves, but that's another good place to look, because if you belong to a credit union, check out their websites, and their staff actually internally is trained. So that's another way to go. If you are more comfortable face-to-face and talking to someone, you can certainly do that.
So I just wanted to clear up this one question from Renee. She's saying, are you suggesting that we do a loan freshman year to cover all 4 years because the rates are low right now? That would be nice to be able to do that, but
I wish I would do that. Every year is a new loan. So you would borrow every single year. Unfortunately, you can't borrow one time and keep it for all 4 years. Some lenders do offer, I know there's one.
That's what I was going to ask, if you can kind of, yeah.
There's one bank that offers, or a few banks that offer what's called a multi-year option. And what that means is that they will approve you for 4 years or 3 years or whatever time you need to borrow the loan, but the interest rate will change every year. So for example, we use the LIBOR rate, which is going away, but it's the indice that we use to set our interest rates, and most lenders do in the market. LIBOR changes every month. On a fixed rate, obviously you're fixed for your loan for the life of that loan. But in this multi-year kind of scenario, the rate would change annually. So for example, this year, say you get a 4% fixed rate, that fixed rate would be good for the life of your loan. Next year, when you come back under the multi-year, you say the rates were even lower, it was 3%, you would get 3% for the life of your loan.
So that multi-year review is kind of also looking at, because you mentioned this to me earlier today, kind of also what your potential is of borrowing for 4 years. Is that correct?
Yeah. So that's one thing. And it's kind of a cool tool. Like for those of you that are somewhat anxious that you may not get approved for 4 years, if you check out a bank, there's a bank, Citizens Bank here in New England, where you can apply. And if they offer you the 4 year, then you know that you have, that you're okay, and you would get approved for the 4 years. So
But the reason I bring it up, whether you end up looking at citizens for that 4-year approval or not, it's an exercise that families should kind of think about a little bit themselves, because if you're going to take out the loan in year 1, you're probably going to have a loan in years 2 through 4. So you're building up more debt, and kind of it goes to that exercise of seeing what the 4-year plan is and kind of what your debt might be in year 4, because you don't want to get stuck maybe not being able to get the loan then.
It's true. It's true. And one thing too, before anyone, goes and gets a loan, before you go right to loans, consider payment plans. It's something that's not widely talked about. And sometimes, friends of mine that have kids in college will say, it seems too good to be true. And it is. Most schools will let you pay the tuition over a 9 or 10 month period, interest free. And so on the websites, on the financial aid page, they have something called a tuition payment plan, 10-month payment plan, monthly payment plan, or different names. And for an application fee, say of $40, $50 for the year, they will take whatever you want to pay in cash and split it over those 10 months. Now, you don't have to do it for your entire amount. So say, I know someone asked earlier, what do I do with my cash? How do I, should I put it all down? Well, say that you decide that you want to only, put down $8,000 for the year. You don't have to pay that in 2 semesters. You could choose the 10-month payment plan or an 8-month payment plan and pay it, $1,000 a month. And I think from a budgeting perspective, sometimes it's a little easier to budget a monthly number because you know how much you have at the end of each month versus having to save up that $8,000 and pay it twice.
And I'm just going to emphasize this one more time. If there are people watching who might have a student who's in 11th grade, 10th grade, these are exercises, kind of like with your looking at, these are things you can do now. I mean, I would kind of kiss anybody if you did it now, because, then you're really getting a look into, what your budget is, what you can spend for college. Anyhow, I just throw it out there that if for anybody who with younger kids, these are great things to be thinking about. And people don't normally do it until later in the process.
The last minute. Yeah. And I truly believe it's a conversation that you have to have with your kids beforehand. So as you're going through the admissions process, you're able to figure out, like you can see the sticker price on the website of the school, but most schools also offer something called the net price calculator or the net price of school. So it's very rare. In some circumstances, people pay the sticker price, but it's very rare that someone pays the $82,000 or the $74,000 because there's merit scholarships that your student may earn based on their grades, or you may receive financial aid, your loans. So really go research what the net price is before you decide where you're going to go to school. Because I feel like a lot of the disappointment comes when you get all excited that you've gotten into this great school, but the family can't afford it. And I know that finances isn't something that we always want to openly discuss, with our kids, but they need to know how much you're willing to put towards their education up front. So as they're searching, they're keeping that in mind and what the family can afford.
So Steve is asking kind of like, which is good, an immediate question. Like, if my student is starting this fall, I assume I should be talking to a private lender soon. So maybe you could talk a little bit about timing of how long it takes to get the loan.
Yeah. So thanks to technology, we can do the application very, very quickly. I know at SoFi, because everything's on the computer, and though we do offer it in our app, we find that most parents want to get onto a desktop and kind of work their way around. But provided that you have your income information, and a lot of times we can go right into ADP or whoever your provider is and get that information, so you don't have to submit, the paper doc. You could probably get through the process with your son or daughter within, a half an hour. After that, you get a credit approval. But after that, there is something called school certification that has to occur when you apply for a private loan. And what that means is you apply, you get approved. Say you had to provide some income documentation or an ID verification. Once we have all that, we electronically go to the school and say, hey, is Debbie eligible for this money? Can she have this? She's requested $20,000. The school will come back to us and say, yes, you can have it, or no, Debbie only needs 15. And they certify the loan amount. And that's all done electronically. But I think that's the longest tail in the process. But not to worry, because once you apply and are approved, all of the lenders communicate with the schools electronically. So they can go in and see, okay, well, Debbie's applied and she was approved. It's okay. I know the money's coming. So it's a little bit mysterious, I think, for the consumer because we're doing so much behind the scenes. But call your lender, look online, not to worry. We'll get the information to the school.
And for the reasons that you just explained, because I've gotten this question through email and sometimes online. People ask if they've got twins, can they take out, one loan? Or if they've got multiple kids going to the same school, can they take out one loan? And you can't. You still have to take out the separate loans.
You do. And even if you do the Parent Plus loan and the student isn't on the account as a borrower, you do have to take out a separate loan for each student.
So I'm wondering if you can talk, Melissa, and again, this kind of goes back to our conversation earlier today about how you would recommend people research, different lenders. Obviously, you're gonna, say, please check out SoFi, and I hope everybody does. But, to be a good consumer, they should be checking out a few different lenders. And they, in addition to kind of like where they can do the research, then there's these sites that try and combine a lot of lenders together versus, going individually to the lenders. Yeah. Like, what's your suggestion about how people should kind of try and get their hands around all the information that's out there and then evaluate it for themselves?
Yep, absolutely. So I think one thing that before you start looking for rates, I think you have to be realistic. We all think that when we see advertised rates that we're going to get the lowest rate, we have the best interest, the best credit in the world. But I think you need to really kind of sit down and say, understand your credit. There's so many places where you can get your credit score for free now. Within our app, you can do it for free. I know many credit cards does it for free. So get your FICO score and start searching. So one place to do it is to go to lenders that you are that are recognizable to you. So, for example, we talked about Citizens Bank, Discover, SoFi, Sallie Mae. Everyone tends to think the big lenders like Chase and Bank of America are in the industry. They are not.
Right.
You can go to the websites, but there are these aggregator sites that are out there. For example, I think Credit Karma or NerdWallet, things like this that offer a one-stop shop to search for rates. And what's interesting about them is that those sites are purely a rate-driven exercise. So if you wanted to go, for example, put in some information, you would, the engine or the provider would go out to multiple lenders and bring back rates that you would likely be approved for. Debbie and I were talking about this earlier, where she had a friend that got an interest rate back, went to the lender and applied, and actually ended up with a lower rate. So it's a directional rate. It's not a guaranteed, but it will give you an idea of what you could be approved for and what rates the lender would give you. An important thing to be wary of, though, not every lender participates on those aggregator sites. As you guys know, much like Kayak or some of the other aggregators, lenders pay to be on those sites. So it's definitely driven by volume and, who's the largest player. The rates are real. They cannot be taken away. It's not like something that they can bait and switch you, but that is really for rates. And as we talked earlier, there's so many different features and benefits that are offered by private lenders. I don't want, rate is certainly important. And number one in our research, when we ask people what's the most important thing to them, but also repayment term type and other options should also come into the consideration phase. So use the sites and go directly to the lenders, get your FICO score, compare, and apply.
And maybe can you go a little bit through what the other features are and why they might be important to somebody in addition to just the rate?
Absolutely. So one of the things that the federal program, as we talked about on the Parent Plus loan, it's in your name, the student can't take it over. But on a private loan, one of the things that some of the lenders offer, SoFi included, is something called co-borrower release. So for example, when you are a cosigner on your daughter or son's loan and they graduate and get a job, after a certain number of payments, so it depends on the lender. It's somewhere, some are 12 months, some are 3 years, but after a couple of years of payments being made, you can actually contact the lender and be released from the loan, and the student can take it over themselves, which is a really cool feature for those of you that want to help your son and daughter in the short term, but want to kind of get off the hook once they graduate. So that's one feature that is important to look at. Repayment options. So do you want to make a small payment while the student's in school, but not make that big principal and interest payment because you're expecting them to graduate and get a big job and take over those payments since the loan's in their name? So optionality. Do I have to pay? And repayment term. We talked a little bit about that at the beginning of the call, but some people may want a 5-year term. Some people may want a 15-year term to stretch that out. And so I find that in the private market, it's that optionality that's going to help get into your kind of budget sweet spot versus, perhaps just going into the federal program. I don't want to I want to give the plus loan like its equal shine too, because for those of you that do have credit or a FICO score, or maybe, especially during these COVID times, have income interruption, and that you will get back to work, in a few months, but you really need to get that loan now, the federal plus loan is there for you, and you should absolutely use it because it is not income. It's not income driven. You do not have to prove that you're working. So for those of you that may have been displaced and you're going back in a month or 3 months, and you really want to help your student, the parent loan is an excellent option.
That's good advice. And then I guess also the rare case, hopefully, that you may not even be approved for the Parent Plus loan, your student can get some extra money to borrow for the Stafford loan. But but as you said, in most cases, it's not based on income, and it does cover a majority of people, the Parent Plus loan in terms of
right.
Yeah.
That's right. And one nuance too is that if you do apply for the plus loan and you are declined, for example, say that you did have a bankruptcy or a foreclosure or something on the credit bureau, once you are applied and declined, there is the optionality for your student to get increased funds through the direct Stafford program. So definitely a great option for those of you that have some uncertainty.
And maybe, again, kind of like in these options that we're talking about, maybe expand on the importance for some people of managing the monthly payment amount. And that's why all these features are so important, because as you change the length, or you can manage what your monthly payment is, which sometimes is the driving factor for a lot of people.
It is. And I think it's like how I usually shop for a car. So, and I'm sure you guys do it too. When you're shopping for a car and you need a new car, you instantly go to, well, what can I afford a month? And I think that's what gets people to, lease or buy or change what they want. How much can you fit into your budget? And I think that's where the optionality comes in. If, for example, you need to borrow $30,000, $40,000 in a year, the payment on that in the private loan market is going to be around $500 a month. Can you swing it? And that's over a 10-year period. Or do you think like maybe the first couple of years you'd be willing to pay the interest and maybe pay more later? That would be an option, right? So you could take out a private loan, choose the $25 payment that SoFi offers in our fixed payment, and then accelerate later in the program. But the one thing to remember in the private market, at least, is that the repayment option that you pick at origination is the repayment option that will follow that loan while your student is in school and during repayment. And it's important to remember that, because we've had, people say, well, I'm going to take that full repayment. I know I can do it. And 2 months in, go, well, I don't want to do that anymore. I want to get full deferment. Unfortunately, you have to, whatever payment you choose, you have to carry that out through your repayment term. So an important thing to remember as you're planning, can I do this payment? Can I make this payment, for these years?
And just the opposite, if you pick a payment plan maybe on the lower side or something that's, smaller, and then you find out that you can pay more, you can end up paying off faster.
There's absolutely no penalty for prepayment. So at any time, and if you won the lottery and you wanted to pay the whole thing off in 3 months, you can do that too.
So there's been a few questions about, is there any way my student can get a loan without a cosigner? Or, are we fairly certain that they're going to need a cosigner? Maybe explain a little bit, why the lender, why most loans do need a cosigner, at this age and for this type of loan. And I don't mean to, discourage anybody, but it's probably unlikely that the student is going to be able to get a loan without a cosigner.
It's absolutely unlikely, especially if the student is a freshman or a sophomore, because with the credit crisis that we had back in 2008, with all of the mortgages and all of the loans kind of going south, a lot of regulations and rules, good ones, were put in. And the most important one, I think, for this group is that you can never make a loan unless the customer has the ability to repay, and they must demonstrate that. And that's what we test when we do the credit check on private loans. We say, can this family afford this loan, afford this payment? Now, the student is in the first position, usually on a private loan. And what's good about that is that they get to establish credit. They have debt in their name. It's, under their kind of profile, but it's your income and your credit that gets that great rate. Because and I'm sure, some of the audience would feel the same way. Would you give your child a $10,000 loan at 2% today? Unlikely. They're not going to have it to pay it back. So it's really as the student goes on and demonstrates their ability to repay. Now, there's one lender I know in the industry that will lend to juniors and seniors without a cosigner, but there's some rigor around that. But lenders really need to see the progression through school, because getting through the freshman year is critical to repayment. We have people that drop out, transfer, don't go back, take a year off. We really want to see the progression through the 4 years before we can say you may not need a cosigner.
So this is just a little bit of terminology, maybe to clean up or clear up. Whoops, sorry, here. Eileen asking, what's the difference between a co-borrower and a co-signer?
Yeah, great question. It does mean different things. So in some cases, it means, so on a co-borrower, it means we are borrowing jointly 50-50. So my son and I, we own the debt 50-50. A co-signer, the responsibility is on you secularly. So if the underwriting is done to the parent, and you would be held responsible.
And what about, I've also gotten this question, or people have explained to me that they've done this, is, you only need one person as the cosigner. A lot of cases, there's two parents that are around, and they try and figure out which is the better parent to try and be the cosigner, because there's slight differences in the, financial record of those parents. So is it possible to ask to kind of test out, who might be the better cosigner to get a different rate or better rate?
Go with the parent that has the higher FICO. And if we have a parent that's not working or working, obviously go with the parent that is working at the time for income. I have seen in dual family incomes and multiple children, the mom will take one kid through 4 years and the dad will take the other through the 4 years, just to have it separated. So it's because you are evaluated also on the debt that you take on. So if you're taking on $10,000 a year, you have 3 kids, that's a lot of debt on one parent. And that's when we sometimes see, like, aunts and uncles or grandparents offer to help, but all the more important to start the planning now and really trying to use as much cash as you can, even if it's a small amount, really try not to borrow that entire gap.
Whoops. I missed. Here. Mary is asking, do private loans have origination fees? Like we talked about with the Parent Plus loans?
Yeah, they do not. So they're in some cases, some very, like if you're an international student maybe, or if you're going to what we call a for-profit school, so a trade school or something like that, there may be a fee associated with it, but that's the nice competitive point between private and federal is there are no origination fees.
So lots of questions that we'll still get to, but I wonder if you could talk about kind of like the situation that people are in these days, meaning some schools are going to reopen, so kids are going to, go to campus for those schools? And what happens if you take out a loan and let's say come October, the school is still going to continue with classes, but they, need to send everybody back, or maybe they have to turn virtual. So what happens with the loan amount that you took out, which is bigger because it's covering all these other expenses that are no longer going to happen?
Yeah, so great question. And one that we hear a lot of, especially recently, we've had parents call up and say, well, my child is going to be going online in the fall and not living on campus. So I only need 3,000, but in the spring I need 10,000. How does that work? Because traditionally, as some of you know that have kids in school, your loans are split in 2 disbursements or 3 disbursements equally across the semester or the trimester. So what I would encourage you to do is to go with what the plan is today. So whatever your school plan is today, for example, my son's going to school in Connecticut. The payment was due July 1st. We have paid everything as if it is on campus and he's living there. If they decide that they have to stay home and go remote, the school will handle the refunds. And the way that they handle it, and I know this is a big deal at the end of last semester, those of you that had kids in school and were wondering, where's my money coming from? Generally, they will not rebate the money. They will keep your cash and apply it to the next semester or the next year. If the student is a senior and graduating, there's the opportunity to get that back, but not to worry. So the way that it works is that most expensive funds, the ones with the highest rates, and generally it could be private loans or other loans that you have, are the ones that the school will refund first. So your cheaper loans, your grants, that will stay. It's the school will work with the lender and return it back. So my recommendation is go with the plan that you have today, and that the school will return the money. Now, we often hear the question too, should I apply for a loan each semester? If you need money for the whole academic year, apply for the whole academic year, because when you do 2 loan applications, that's 2 credit hits, 0. They're treated each equally, but apply that one time for the full amount, and the school will handle when the money will be dispersed. You will not be charged interest. That's a question that we get asked all the time. So if I take out a $10,000 loan, are you charging me $10,000 from day one? The answer is no. You are only charged interest on the amount that actually has been paid to the school. So if you take out $10,000, you use 5, and you decide to cancel the other 5, there is no cost to you.
Yeah, that was a question earlier in the comments, was kind of like, how does that whole disbursement work? I think because people get, it's kind of like a behind the scenes thing, and they're not quite sure how it happens, and they get a little nervous, is it really going to get dispersed directly to the college? And when am I going to be charged interest on it? And so they should feel comfort that, this is a process that happens at thousands of schools, and, usually works pretty well.
And I know it's not like on your top 10 list of super exciting things to do on a Saturday night, but you really should read your disclosures. So when you apply for a student loan, there are 3 disclosures, one that you get at application time, one at approval time. But the last thing that you'll get is called the final disclosure, and it will be within your electronic application. You can go in and view it. In that final disclosure, you will see your rates, your estimated payments, and the disbursement date. So most likely, your lender will send you an email with those disbursement dates, but they're also in the disclosure, and they're there the whole time. So if you have a question in November, when's that payment? When am I going to get that disbursement? Go back in and look at it. You can see the dates in there.
So I'm just going to show you this. So Steve says, due date of July 1st. I haven't heard a thing from UCLA about due dates. Should I be concerned? And I'm only bringing this up, for a few reasons, but the last time we spoke, and I remember you said that your son's payment, the due date was July 1st. I also thought it was early.
Really? I'm so glad you asked that question, Steve.
It's really early. It's really early.
He doesn't start school till 2 months after that.
Yeah.
So you should not be worried. You should not be worried at all. And California is going through a super rough time right now. With all of they're going back to phase 1. Some parts of it have not gotten out. And so that affects the staff too. So when you're talking, especially at a school like UCLA and USC, huge, huge universities where the employees are all displaced in their home and don't always have access. Some of the things that they have to do are firewall restricted, or they may not have access in the home. So I know that some schools are waiting to get back in the office and bringing their teams in slowly. So not to worry. And yeah, it is early.
Right.
It changed.
And in fact, Steve, to your question, I actually posted in the Facebook group, Paying for College 101, just the other day, like, are there people who still haven't gotten their final bills? And tons of people, haven't gotten it yet. So, so don't worry. And we should just feel badly for Melissa that she's on the early side.
Yes, I did plan.
Right.
I did plan, and I was actually kind of shocked. But the nice thing was, and so again, just for the families out there that had students that were in college last spring, my tuition bill in July, due in July 1st, was actually a lot lighter, because what they did was they took the refund from the housing and applied it to my fall bill. Great news. But the thing is that just remember that the spring payment in the winter
is going to
be that much higher. So again, as you're applying for loans in that scenario, say you were borrowing $20,000 and you don't have them split it 10 and 10, call the financial aid office and say to them, I only want $5,000 on the fall semester and $5,000 on the or whatever, $10,000 in the spring. There is a new form this year. So this is, on your federal loans, everybody, especially on the Parent Plus loan, there's actually a paper form. It sounds crazy, that you have to fill out as the borrower saying, yes, I want this federal loan. The students have to do it too. The federal government wants to remind everyone, because with processing, it's become so easy. Push a button, get your next loan. Master promissory note for the federal loan, one prom note. And every year, you can kind of hit that. But you're going to have to fill out this paper form. Nothing to worry about. It's usually on the website of the school, or they'll send it to you directly. And the good thing about that paper form this year is that you can request disbursement amounts. So in that scenario I just listed, where you don't need as much in the fall, just write a note on there, $3,000 in the fall, $7,000 in the spring, and then the school will set up the disbursements in the way that you want it.
Oh, good advice. I've seen this question a few times that people are asking, and maybe you could just kind of go over and confirm, like Melanie is asking, can private loans be taken for off-campus housing? And somebody asked, are loans covering room and board?
Yeah.
So,
yeah, I love that question. And the reason is that in your award letter, so you should have an award letter from the school, and it will have things like tuition, housing, your food bill, and then you'll see things like books, transportation, fees, and other. That's a bucket of charges that the school assumes you may need. You may not. You may not have transportation. You may not have those things. So you don't have to borrow that full boat. But if you do, and housing's on there, and you decide that your student or your daughter is going to live off campus, that sheet tells you the kind of what's allotted. There's a budget, what the financial aid office calls is a budget. And that housing cost, you could borrow it if you need to. The money will go to financial aid, and financial aid will refund it or rebate it to your daughter. And they either do that through direct ACH, so she can go in and put her checking account and it goes directly to her, or they'll ask her to come to the office and they'll give her a check, and then she can pay her rent out of there. So most campuses have an on-campus budget and an off-campus budget. So if, for example, though, say, she and her roommates find this great place and it's going to cost $7,000 a semester, the school may not approve it. The school's going to say, hey, listen, we only are going to approve loans for up to $6,000. So really make sure you take a look at that budget and see what they'll approve. But you can absolutely do that. And word of caution, they're going to give her the full semester refund at once. So make sure she doesn't spend the 4 months rent that you expect her to pay out of the loan.
That is actually really important, that they give it all at once. I would also be very careful about how they give it. I mean, you gave kind of the clean ways, but I have heard sometimes where they put it on a debit card, or where this has happened in the past, right? Where there were fees that were taken out of the way that money was given back. So just be really kind of on top of how they're getting that money. how they're going to manage it for the full semester. It's a good lesson for them in managing money, but also you should kind of be on top of it.
And one thing I wanted to talk about too, because I know people have been asking about this a lot, is the difference between a soft credit pull and a hard credit pull. So a soft credit pull, which you are offered through some of the sites that Debbie and I were talking about earlier, you can come to the SoFi website and we have a find your rate option, soft credit pull. And what that means is that there is no effect to your credit. You will not get a ding. It will not affect your credit score, because every time you apply for credit, even if you're approved, you will have a reduction in score. It's just the way that it works. So a hard credit pull means that you've actually applied for credit. And that matters to lenders because you can often be judged by how many times you have applied for credit in a month or 3 months or a year. It's a negative thing. So, creditors don't want to see someone applying for 4 car loans and 10 credit cards. It kind of I don't know how the right way to say it. It looks like
it looks like you're in need of borrowing money. Yeah. And so it's right. It's
exactly
good. It doesn't reflect well on you, particularly from a creditor standpoint.
Exactly. So the nice thing is though, is that credit bureaus specific to student loans will allow you to shop for rates. So go to the lender's website, check the rate without having a significant hit to your credit. So like we were just talking about, if you try to apply for 5 credit cards, that's going to be a negative. But if you're shopping for student lending, they will allow you to do it within a 30-day period. So, and it will not, it will count as one. What I would suggest though, is do your homework, figure out who you want to check out, and do it all within a week. So that you can get the rates at that time. Just to kind of FYI, lenders tend to change their rates.
Right. Over 30 days, the rates could change. So
they can. And so, pick your week, check everybody, and it will count really as one inquiry as long as if it's done within 30 days.
So that was a lot of great information. I'm just going to summarize because there was like a lot of nuggets of good information there. And so the summary is, do your research up front. You can ask or get some soft credit pulls from lenders if you want a little bit more narrow range of what your potential interest rate is. But then maybe you narrow it down to 2 or 3 lenders that you truly are interested in getting your actual rate from. Go and apply within, in the week or so that Melissa is recommending, and get all your information. You said this to me earlier today. You didn't say it tonight, but I love the idea of kind of doing it the old-fashioned way. Write it all out. Just have all the information about each loan that you're potentially considering, rate, options, all the different features that you might have chosen if you did a 10-year or a 5-year, and kind of lay it all out and kind of look at it all together and then make your decision.
Absolutely. And have your kids participate. Make them pay $500 a year, make them work or pay $200, have them do something, because with skin in the game, there's a pride. They're contributing in their education, but they're also helping you guys out too.
Okay, so we're actually almost coming up on the hour, which is fine. And I'm just looking through all of our other questions here, if there's anything we might not have covered, because we did talk through a lot. I'm going to ask this is a topic onto itself. And so we're not going to go into depth, but, maybe that will be another time. But people have just asked, and this is now people who are further along and maybe their kid has graduated. Can you maybe just touch a little bit on refinancing? And I know that is a huge topic, but people ask me, I got an email today, does SoFi do refinancing? And do I have to wait until my students out of college to start refinancing?
Yes, we do refinancing, and I'll brag. We are the best at it, and we're the biggest.
Well, that's how you guys started.
Everybody, rates are at historic lows, and so if you have loans in repayment, you have to have graduated. So you have to be out of school. Absolutely refinance. And you can refinance your federal, your private, or your federal and private together. Word of caution though. So as many of you know, there's something called the CARES Act. And the CARES Act was passed by the federal government during COVID times, and interest rates on your federal loans were dropped to 0 on a lot of, depending on when they were originated, which is a great perk. So check out what the rates that you have today. For some, we have not seen a dramatic decrease in the application volume, because what students are doing, especially those in the graduate programs, they're saying, well, I could get this interest rate discount or no rate, I'm saving $100 over 3 months of the CARE Act, but I'm saving $400 a month on my payment if I refinance now. So just check out your options. So I would not encourage anyone to pass up the federal benefits ever. So check those out first. But historically low rates, and we predict them to be low through next year. So check it out.
Particularly, honestly, in the past few years, before the interest rates were much higher on student loans. So people might have, loans that are in this, 6%, 7%, and compared to, what the refinance rates are now, it's a big difference.
And it's a meaningful difference. And we can save people thousands of dollars over the life of their loan just by reducing their rate by 0.5%. In some cases, we're seeing them go down 4 and 5%. So definitely, now is the time.
Okay. Well, thank you, Melissa. This was
thanks, Debbie. It was very fun.
A ton of information. For everybody watching, these things are always recorded. They are on the Road to College Facebook page. If you're on our email list, we send you out a link, but definitely come back and rewatch this, because it was a lot of information. Have your child come back and rewatch it. That's a good lesson for them. But now's the time for anybody needing to take out a loan. There's no more waiting. You got to start acting and doing your research and get started. And who knows what the fall will be like, but we'll be around and we'll help you through it. So
good luck, everybody.
Okay, thanks, Melissa, and take care, everybody.
Bye.